Hey traders, Jason here from Leva Brothers. So, going to do an update of my State of the Market series. It's about time. I haven't done one of these in several weeks. Going to go through the indexes, some breath readings, but I'm actually going to look underneath the surface mostly because I think that's where the true story is. And I mean, I'll tell you right now that the true story is that there's just a lot of conflicting things things that just aren't lining up, aren't making a whole lot of sense. Can't really make a strong case for a big move up or down right now just because there's so many just things butting heads. Definitely not an easy trading environment, very challenging in my eyes. Okay, if you're a day trader, this could be a great environment for you. But for me as a swing trader who wants to kind of play a trend, it's been a challenge for sure. All right, let's go through some indexes. Let's go through the S&P, then we'll look under the surface and see what's going on. All right, so here's the S&P weekly. Amazing rally off of last April's low. Now we're in consolidation mode. Tightening up. I don't know what the Bollinger Bands are, but I'm guessing the Bollinger Bands are very, very tight. Rode its 8 EMA up, dropped to its 21, and now it's straddling the 8, getting support from the 21 here. It's like from a trading standpoint, this is frustrating because the S&P is unchanged going back several months, but from, if you stand back and look at the big picture here, this is like the 2+ year chart. We have an amazing rally followed by just a multi-month consolidation pattern. Nothing wrong with that. Okay. Even if it dropped out of here and found support at the last low, we could continue to trade in a consolidation pattern that's just bigger. Okay. That is the way it is. Trading is challenging right now. A lot of it has to do with conflicting stories beneath the surface. And then some of it has to do with just the fact that the indexes haven't done anything for, many months. Okay, it is what it is. We got to deal with it. The market changes, and you got to make slight adjustments to how you operate, or else you're going to get steamrolled. Okay, like 2025 trading methods are not working right now very well. Okay, so if you keep doing the same thing, you're going to get run over. If you make your adjustments, then you can do fine. All right, let's go to the next one. So here's the S&P daily chart. Seems like a little bit of a rounded top. You had a high here, then a low here, and now we got a rounded top here. Okay, we got higher highs over here and lower highs here, and this same support across the bottom. Looks like a big rounding top. I drew a line here that shows where a 10% pullback would be. A 10% is like not even average. Okay, if you go back decades, you typically get 13, 14, 15% drop. Even in good years, you still get like 7, 8, 9, 10% drop intra-year. So even if the market was in really good shape, getting a 10% drop like that would actually be very normal. It's not even out of the ordinary. Okay, so a lot of technicians will say, hey, this is some sort of a topping pattern, support here. If it takes out support, it's lights out. Well, not necessarily. As I said in the last chart, certainly we could fall out of this range and form a bigger range, but even if we fall out of the range, it doesn't necessarily mean the market's going to completely fall apart. So this is the chart now. Here I'm going to pull up the chart from 2014, 15, 16, 17. So you can see a little bit of a similar formation here where we had a rounding top here. And you can see we fell hard here, double bottom, rallied back up, lower highs, rounded top, fell to a lower low. It very easily could have, I'm sure there's some technicians back then that drew some trend lines like this and said, hey, we got a big rounded top. It just broke down. Market's going to fall apart. And what it did is it double bottomed here and then, as you can see, went up. Okay. So even if we right now drop to a lower low, history doesn't have to repeat, but I just show this just to kind of remind you that just because we take out a support level doesn't mean the market's just going to completely collapse. Okay. It doesn't. Individual stocks, that happens, but with the overall market, it doesn't always happen like that. And to take this a step further, here are the pullbacks from back then. This was 10.2% pullback there, 12.7, 14.7, 6.4, 5.4. So during this entire rounded top pattern, we had 3 different drops, more than 10%, and then even when let me get rid of that. Even when we went up here and negated the bearishness of this entire rounded top, we still had a 6% and 5% pullback before 2017 was an amazing year. Okay, so be open-minded. Okay, we don't want to jump to conclusions. The market can move down here, certainly. even in a good year, it tends to move down a bunch. Not a bunch, but it certainly can move down 10%. But just because it moves down a lot doesn't mean it has to completely collapse. We don't have to have a repeat of the dot-com bubble bursting. This is an example right here where, drop to a lower low, drop to a 2-year low, and the market double bottomed and then went back up. All right, let's check out some breadth readings quickly. Here's the 10, 20, and 50-day moving average of the NYSE AD line. You can see the 10 moving average has been pretty much above zero for the last 3 months. The 20 has also been above zero. The 50-day moving average of the AD line has been zero. So there's damage under the surface. We know there's a lot of stocks suffering right now, but there are a lot of stocks that are doing really well. Okay, the AD lines have held just perfectly fine. So we don't want to get too bearish out here. Here's the cumulative AD line. You can see, moved up, moved sideways, moved up to a higher high here, flagged for a couple weeks, and it's been in a steady uptrend since. So again, yes, there's damage under the surface. You don't want to be in the stocks that are lagging, but there's quite a few stocks doing fairly well because, since the November bottom, advancers have steadily outpaced decliners, since then. Another look at a breadth reading. Here's the 1 month high low. Okay, so the number of stocks printing a high versus a 1 month high versus number of stocks printing a 1 month low. The market high is here. The market low here when you're talking about like a 1 month time frame, and the S&P is pretty much right in the middle, a little bit below the middle. Okay, so it's not a surprise that the number of stocks printing 1 month high, 1 month low is pretty much sitting right in the middle. Okay, here's the zero line. We've gone above zero, we've gone below zero. Right now we're below. No high prints in either direction. Kind of tells you that we just have a neutral market. Market's in consolidation mode, and the number of stocks doing really well or doing really poorly have dampened down to the point where there aren't a whole lot of outliers out there. Okay, same chart when you're dealing with the 3 month high low, and the picture is the same. We got lower highs here, a higher low here. We got a print here just below zero. I think the biggest warning could come if the S&P were to make a run at its high here, but this were to like barely bounce and then roll over. Okay, that would be a big warning. Okay, right now I don't see any major warnings, but that would be the warning that I would look for. If the market ran up and the high low on the 3 or on the 1 in the 3 month time frame did not move up to match it, that would be a warning. Okay, so right now we just have a neutral reading that's not really telling us much. Now we have Russell 3000 stocks above the 20-day moving average. Okay, support here, 40, lower highs here. Certainly there's been some deterioration. So the mechanics of this are the 20-day moving average. The S&P has been trading in a range long enough that the 20-day moving average is like somewhere right in the middle. So the S&P itself goes above its 20, below its 20, above its 20, below its 20. So on any, the market can move up 2-3 days in a row, and you could have an expansion over here. The market could go down 2-3 days in a row. We can have a contraction over here. Right now we're at 45, 46%, just below 50%, which is kind of what you'd expect given that the 20-day moving average is somewhere in the middle here. Okay, like the last one, I would consider the biggest warning would come is if the market could make a run here and this didn't expand much. Maybe it expanded a little bit and then rolled over. That would be a major warning. Okay, that would tell me that the S&P is trying to move up, but the number of stocks participating is not matching it, and that would be a warning. So as of right now, I would consider this reading to be neutral, and we'll get valuable information on the market's next move. Okay, here's the same chart with the 50-day moving average. It's similar. We have a 53% reading right now. The 50-day moving average comes in like this, and then it also has flattened out. This range here goes back long enough that we have the S&P itself is straddling its 50-day moving average above, below. We've had steady decline here. So if you look at this, it looks bad. Okay, but the absolute reading right above 50% is about what you'd expect given that the S&P 500 itself is just straddling the 50-day moving average. Okay, the problem comes, so if you look at the S&P back here in October where the S&P went up to a new high, but the stocks above their 50-day moving average moved up a little bit but didn't move up that much. That was a warning. Okay, and then it moved down here and then tried to move up again, but we got a lower low. That was, that's your warning here. So if the S&P moves up, but this fails to move up too much, that's your warning. All right, let's now look at the truer picture. Like the indexes could lie to us. Breath is doing fine, okay, because there's enough stocks doing well, but I think the true picture is seen beneath the surface. These are 9 of your MAG stocks, and this is kind of the bigger issue. So this is probably hard to read, so I'll go through it. So Apple's mostly, change the color here. Apple's mostly flat going back several months. Microsoft, very weak. Google did great, pulled back here. Okay. Meta, flat over the last couple of months, but the high is over here, so it's actually been bad. Amazon was just kind of grinding in a range and then collapsed. Tesla tried to break out over here and has been really weak since. Nvidia, they have earnings tomorrow, flat for several months. Broadcom, flat for several months. Palantir dropped from over 200 down to like the mid 120s. Okay, so what's doing well here? I guess Apple's doing okay. It's just holding up. Google's doing well. The rest of these are at best flat and at worst doing really poorly. Tesla, Microsoft, Amazon. So the question is, maybe some resource stocks are doing well. Industrial names are doing well. And I'll get into a couple groups that are doing well. Energy's doing well. Utilities are doing well. But can the market move up when you have all these are your biggest big cap stocks? They're doing poorly. Okay, that's the tough part right now. So the advanced decline line could be trending up, but Apple is probably equal to like every energy stock combined. So do you look at the advanced decline line because energy is doing well, or do you look at Apple? Okay, that's the question here. That's how some of the indicators can lie. We know this is IGV. Software has done very, very poorly. Okay, we know that. So this is where I'm going to get into some of the conflicting stories here. Software really, really weak, but then here's semiconductors. Oh, that's terrible. Semiconductors have done well. In fact, the gap between semiconductors and software is the greatest it's ever been in history. And typically they move kind of together. They don't have to move exactly together. But if the economy's doing well and tech's doing well, you're going to get software and semis to do well together. Obviously with AI requires semiconductor chips and they kill software. So the gap between them is huge. So you have great tech companies that are doing great and other great tech companies that are just getting clobbered. Transports are doing really well, as you can see. So if you think if transports are doing well, they're probably shipping goods. If they're shipping goods, that means retailers are doing well, right? Well, no, retailers are down near the lowest level since last June. Okay, so shippers doing well, retailers not doing well. That doesn't really make a whole lot of sense. Airlines are doing fairly well. Moved up, consolidate, moved up, now consolidating again. So if airlines are doing well, that means people are out and about living their lives, traveling and stuff. Well, here's travel and tourism group. Okay, it's getting crushed. So that's another one of those things that doesn't make sense. If airlines are doing well, you'd think travel and tourism industry would be doing well too, but it's not happening. Energy's doing really well. Utilities are doing really well. Consumer staples are doing really well. But then we get back to the MAGs stocks where, came down here, moved up, lower low, got rejected by moving averages, lower low again, now moving up again. Seems like we got like a rounded top going in here. So, some things that just don't make a ton of sense when you see airlines going up, but travel and tourism not going up, when you see semiconductors doing well, but not software. There's a flight to some safety with energy and utilities and consumer staples doing well, but like all the big tech companies are not doing well, except for semiconductors, which are doing fantastic. So there's a lot of conflicting things here. The net of it is the indexes look pretty good. Breath is doing just fine. It's neutral right now. It's just fine. But beneath the surface, there are things that just don't make a whole lot of sense. Trading environment is challenging. This is not a time to be a hero. This is not a time to push really hard. Huge money will be made on the other side of the slop that we're currently experiencing. The key is don't lose too much money right now. You want to protect your capital so that when things get better, you could start close to your high water mark instead of starting in a hole. and you also want to protect like your mental, you want to protect your mental capital. Okay. You want to be like full of confidence when the market, when we get to the other side of this, you want to be full of confidence and not starting in a hole. Cause otherwise you trade, but you trade small size, you make some money, but you don't make as much as you should have. All right. So the sum of this is just like the market is neutral right now. There's conflicting on the surface. It looks fine and neutral, but beneath the surface, there's a lot of conflicting things going on. Not a time to push hard, lay low. Don't lose money right now. Better times are coming, and you can make you can make more money in 2 months on the other side of what's going on right now than you can grinding it out in the next 6 months. Okay, so not a time to push hard right now. Be conservative. See you next time.